My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people make friends. I'm just trying to make you a little money. My job, not just to entertain, but to explain all this stuff. So call me 1-800-743-CNBC. Tweet me at Jim Cramer. Remember today. Remember it because it's a textbook reminder of what happens when you decide the mega capitalization stocks are done, when you think that they're written off, when you decide the moment you give up on them, what happens? They come roaring back. Yep. While the market meanders, Dow inching up 124 points to a record high, although it was down at one point. S&P advancing 0.57%, also a record high. NASDAQ gaining 0.63%. The old favorites rose up as if by magic and began another run. I know what they are. They're almost like Santa's reindeer. There's Dasher and Amazon, Dancer and Alphabet, Prancer and Microsoft, Vixen and Apple, Comet, Meta, Cupid, Tesla, and, of course, poor left-behind Rudolph, the NVIDIA reindeer. Let's start with Apple. All right, here's a company that's being highlighted as the second biggest loser in the Justice Department's case against Google, as Google paid Apple a lot of money to be the default search engine. Hey, why this is bad, this eludes me, okay? Google's the best. I'm glad it convinced Apple, which could have chosen an inferior platform, but the Justice Department wants the deal smashed so it would be terrible for Apple, at least theoretically, because Google pays them something like $20 billion a year for the privilege. So why is this not going up? Well, some of it's the residual impact from a piece of research yesterday. Morgan Stanley put out a bullish note about how iPhone upgrade rates are actually improving and the new Apple Intelligence might be making a difference. But you know what? I also think CEO Tim Cook, who's in China right now, when President-elect Donald Trump is actually talking about a 10% tariff on top of what we already placed on Chinese imports, that shows that he may be the only American business person to truly offer China a great deal and get one in return. In fact, I think Apple's up because the China tariff could have been much higher. If 10% is the opening bid, then you have to believe that things are a little more collegial than we thought. It's a good reason for the whole market to rally, not just Apple. If the relationship with China can improve, then Tesla's a big winner, too, as long as it doesn't improve too much, because the Chinese have some amazing electric cars that they're already facing 100% tariffs here. Still, China's a very important market for Elon Musk, the man who has Trump's ear. Not only that, but when Trump wants to slap a 25% tariff on Canada and Mexico and a 10% one on China, the Chinese might see that as an olive branch coming their way. Oh, boy. And of course, did I ever have the wrong view on Canada? Apparently, it's a hotbed of illegal immigration and fentanyl smuggling. Who'd have thunk it? Amazon's got a nod from Bank of America this morning. It's pretty generic. It's talking about the strength of e-commerce and the cloud and online advertising. Wow. Now, you could say, so what? But think about this. Do you know how many companies would love to get a nod like that out of nowhere, yet they almost never get them? These companies do. Now, the big gain in Microsoft is a little convoluted. This morning, Best Buy reported a subpar set of numbers, sending this charitable trust holding down pretty hard. Thank heavens we've been selling a lot of it ahead of the quarter. In response, we had to do it because we saw the earnings from Home Depot and Lowe's. But CEO Corey Barry said one of the standouts of the quarter was the AI PC, although it hasn't really broken out. I figure with the domestic computers growing at 5.2%, some laptops up 7%, some have to be AI. Barry explained that replacements and upgrading drove the gains. As she put it, quote, "We're excited about what's going to happen in the future to AI," end quote. Now, frankly, I actually regarded this as a tepid endorsement, damning with faint praise, so to speak. But you have to understand, winners get the benefit of the doubt, and Best Buy's presumed AI PC numbers can be read as a rousing applause for Microsoft's Copilot. I wish I could come up with a good reason for why Meta platforms soared today. I mean, there are some amorphous positive comments about how Meta's smart glasses have taken China by storm. They're very cool. I get that. Pretty soporific, though. It could be going up because it's being buoyed by the myriad Magnificent Seven ETFs. So it's kind of like this, all for one and one for all. They all go up. I like a stock that can go up big on nothing, but I have no allegiance. It can therefore come down hard, too. That said, think of it like this. There's not a lot of supply on the way up. And on the way down, there's a company's gigantic buyback, hoping it'll help cushion the blow. That's what I call an asymmetrical positive. And then there's NVIDIA, the Rudolph Red-Nosed Reindeer of the Magnificent Seven. NVIDIA stock is struggling in a typical post-earnings miasma. We know that nothing's wrong. We just saw the numbers. They were terrific. Yet there's a growing skepticism that things have peaked, that the rate of growth is slowing, that the bang for the buck is lessened, and that the competition is increasing, especially from Amazon. Of course, we hear this every time. I want to unpack these supposed negatives, and not that I know who packed them. First, Amazon is not going to go into the high-end chip business away from NVIDIA. It simply needs a regular supply of other chips. NVIDIA has a shortage because they literally can't find enough manufacturing capacity to meet the demand. So Amazon makes some of them itself. What matters, though, is that NVIDIA welcomes the competition, if you can call it that. I don't want to. Look, here's the deal, okay? NVIDIA still has the best technology, by far, in my view. It has no competitors. Amazon remains a huge and, I am told, from both sides, happy customer. Next, has AI really peaked? I have so much trouble with this. NVIDIA is rolling out software as part of its stack, and I think that many people don't even know that what they have going for them. I don't think that people know they have software. Which brings me to Fugado. This morning we found out about a project that fuses sounds and inspires ideas, not unlike what Shantanu Narayan does with Adobe. They put ideas out there to inspire, to get people thinking. Fugado, as CNBC's own fabulous Deirdre Bosa explains, is part of NVIDIA's moonshots. It's an AI idea factory product. It's not a retail thing, even as we can all play with it. What matters is that periodically Jensen Huang, CEO, puts out ideas that turn out to be very, very big, like his DGX operating system that actually began from NVIDIA's Shield, including its Shield TV. As usual, it's a little complicated to explain, but Jensen put Fugado out to get everyone thinking, and no more than that. No more. There's a lot of NVIDIA that's simply a big think, the sort of thing that good companies used to do all the time. But if they're costly and expensive, they don't get done anymore. I actually love these kinds of analyses. They don't depend on the Fed. They don't have anything to do with Washington, the beige book, whatever, with the possible exception of possible not China. It's just the usual blocking and tackling that these companies keep giving you that I love so much. Here's the bottom line. Don't begrudge the mega caps. Don't begrudge them. Don't spoof them. Don't even attack them. Just buy them. Joseph in Connecticut. Joseph.
Yes, hi, Mr. Cramer. My name is Joe. I'm from Connecticut. I want to buy 1,000 shares of Intel Corp. Do you think that it might double or triple in the next 2 to 3 years?
No, I don't think it will. I think it can go up slowly. I know that Qualcomm was rumored to be a suitor. Looks like they've cooled on that. Intel doesn't have the balance sheet to go up that fast, and it's just not going to be a rocket ship. It's just not. I would prefer you to buy AMD. Let's go to Sam in my home state of Pennsylvania. Sam.
Jim, listen, as you already know, the talk of the tape today was all about tariffs. And so my question is, we have this American darling, this great brand, Nike, and I'm curious what you think how investors should be viewing the stock with the potential overhang for tariffs in the coming weeks.
Well, it's negative, obviously, and we know that companies other than Apple have had a really hard time in China. I will say this. I know it's tempting. I think you have to wait one more quarter. We may need a clearing of the decks quarter before we really feel that Elliott Hill's got this under control. Let's go to Larry in Florida. Larry.
Hey, Jim. With the Blue Halo acquisition, possible cuts in defense spending, and lack of support for Ukraine, is all this just too much to start a position in AeroVironment now?
I think that AeroVironment will be and will have demand for many, many years because they represent the less expensive way to get things done. Remember, AeroVironment is unmanned. Most of the things that the Pentagon seems to want are very expensive manned. I think we take humans out of the equation if possible, and that's what AeroVironment does, which is why that stock remains a buy. As we see from days like today, the moment you give up on these mega cap stocks, they come roaring back. On Mad Money Tonight, what should you make of the latest round of retail earnings? I'm highlighting my key takeaways. Then Intuit broke out earlier this month from before falling after earnings. I didn't understand this, so I'm going to dig into what happened to the company behind TurboTax and QuickBooks. Plus, I'm checking in with the CEO of PC maker HP Inc., fresh off today's report. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Before Wall Street could start to wind down for Thanksgiving, we got a gauntlet of retail earnings reports this morning. The off-price chain Burlington Stores, Charitable Trust Holding Best Buy, Cramer Fave Dick's Sporting Goods, flailing department store chain Kohl's, and Abercrombie & Fitch, the apparel retailer that had an incredible second act over the past couple of years. I want to go through these quarters in rapid succession, just like my old pal Chris Berman does with his fastest 3 minutes, covering a week's worth of NFL action in ESPN. I can't go as fast as Boomer. I'm not going to. So let's just call it the fastest 7 minutes in retail. First, let's set the stage. Last night, President-elect Trump announced blanket 25% tariffs on all goods coming from Mexico and Canada, along with an additional 10% tariff on anything from China. Maybe those are just the opening bid in negotiation, but even if that's the case, tariffs are bad news for retail. So the 5 retailers that reported this morning were already swimming upstream. With that in mind, Burlington Stores reported first. Now, this is an off-price chain like CNBC Investing Club stock TJX, and that's been one of the best subsets of retail. Unfortunately, Burlington reported soft revenue with 1% same-store sales growth. Wall Street was looking for 1.9%. Earnings were just in line. Burlington also trimmed its full-year same-store sales forecast, and while they raised the low end of the full-year earnings forecast, their outlook for the current quarter was mostly below expectations. Brutal. Now, the company blamed warm weather, saying their same-store sales would have grown 4% if not for poor sales in cold weather categories. And the market seemed to kind of buy it. Stock didn't get hit that hard today. Still, and listen to me, if you want an off-price chain, you got to go with TJX, maybe Ross Stores. But TJX, I think it's just all-time high now. People thought the quarter was bad. Idiots. After that, at 7 a.m., we got a trio of retail reports. Let's take these best to worst. The best, yes, was Dick's Sporting Goods in the category killer in the sporting goods and athletic apparel space. I am a big fan of Dick's and told you to buy the stock after it pulled back 5% in response to the last quarter. While it hasn't recovered since then, today's numbers show you why I am sticking with it. See, Dick's delivered a 7-cent earnings beat off a $2.68 basis, higher than expected revenue, 4.2% same-store sales growth. Wall Street was looking for 2.7. Dick's also raised its full-year forecast across the board. This is a textbook beat-and-raise situation. Now, initially, the stock rallied more than 10% in pre-market trading. But after opening up more than 5%, Dick's it quickly got deflated, dragged down by heinous action of the rest of retail. And that's when we started to see some criticism of the quarter. Analysts talking about rising inventories and pearl clutching about the fact that the same-store sales growth was mostly driven by pricing, not traffic. I think they were just looking for excuses to justify why the stock was going down. I refuse to play that game. Dick's is a buy, especially after today's modest pullback. You're getting a strong quarter for free. In that sense, it feels like TJX. Next was Best Buy, which we own for the Charitable Trust, although we've been cutting the position going into the quarter after Home Depot and Lowe's told us that, look, be careful. The big-ticket items aren't selling that well. Best Buy's results weren't terrible, but they also weren't great. Weaker than expected earnings, appliance sales really bad. Same-store sales, which were down 2.9%. Company also issued soft guidance for current quarter same-store sales, and then they lowered their full-year forecast across the board. Ouch. On the conference call, CEO Corey Barry explained that there was soft demand in September and October in the run-up to the election. But she said November was off to a good start, with total comparable sales up 5% in the first 3 weeks. She also noted the PCs sold very well in the quarter. Overall, though, this has become a trickier situation than I'd like, and I'm glad we sold most of our position for the Charitable Trust. We told the CNBC Investing Club that we'd buy this one back if it reached the 70s, but it's still at $88 and change. No thank you. Probably be a seller, not a buyer. The third retailer we heard from at 7 a.m. was Kohl's, the struggling department store chain. As I told you in last week's game plan, Kohl's should be considered guilty until proven innocent. And let's just say they didn't prove themselves innocent today at all. Kohl's missed expectations across the board. Missed badly. Same-store sales down 9.3%. You know, that's just a hair below the crucial 10% same-store sales spiral that very few retailers ever come back from. Their earnings at Kohl's per share, they were down more than 60% year over year. Management cut every single line of every forecast, which is how you end up with a 17% decline in your stock. It was just miserable how bad was Kohl's. Bad enough that CEO Tom Kingsbury, who's really good, had to announce plans to step down in January. The poor guy only became permanent CEO in February 2023. He couldn't turn things around. I don't see much reason to think that his successor can do much better. A couple more quarters like this, and I got to tell you, it's going to be real existential at Kohl's. Finally, at 7:30 a.m., there was Abercrombie & Fitch. This was very curious. It's been a greatest comeback story in retail for a long time, most of the past few years. But the stock peaked in late May. It has spent the last few months trading sideways. And things didn't get any better today, as Abercrombie reported an impressive quarter that was nevertheless hated. How impressive? They delivered a top and bottom line beat with 16% same-store sales growth. Wall Street was only looking for 10.6%. Abercrombie raised its full-year forecast, too, though probably not by as much as investors would have hoped. It also issued basically in-line guidance for the current quarter. Nope. Abercrombie's turnaround artist extraordinaire, CEO Fran Horowitz, told I thought a great story, talking about broad growth across all regions, all brands. Abercrombie up 11, Hollister up 21. Initially, the stock shot up more than 3%. More than 6% in pre-market trading, and then it opened up 3%. But like Dick's, the other big winner of the day, Abercrombie flushed lower right away and stayed down, eventually finishing off more than 5%. As with Dick's, the justification for the decline came after the fact, with Abercrombie blaming decelerating growth at the core A&F brand. Sure, growth decelerated, but from a 26% year ago to 11% this quarter. I had to find any other retailer with 11% comps right now. Look, when Abercrombie peaked in late May, it was trading at just over 24 times earnings. Now it's selling at 14 times earnings. It's 10 turns cheaper, for heaven's sake. I say time to step in and buy. Here's the bottom line. The whole retail edifice got whacked today after Trump's tariff. They just made their way back into the headlines. But with 5 major retailers reporting this morning, there's a chance to use the sector-wide weakness to get the best stores at bargain basement prices. Right now, tomorrow morning, I'd be a buyer of Dick's and Abercrombie here, while I am neutral on Best Buy and very unenthusiastic about Burlington and downright disgusted by the house of pain that is Coors.
The house of pain.
Kohl's, excuse me, I'm having a drink of Coors. Now, there you have it. I think that was the fastest 7 minutes in retail. I want to thank Ben Stoto, who is the Chris Berman of our outfit, and he did a fabulous job on that recap. And the Mad Money is back after the break.
Coming up, an intuitive investment? After last week's post-earnings drop, Cramer eyes Intuit's potential. Next.
With everything going on last week, you might have missed it when Intuit reported on Thursday after the close. The financial software leader behind TurboTax, QuickBooks, Credit Karma, and MailChimp delivered what I thought was a pretty good quarter. But the stock tumbled more than 5% the next day. So clearly, the market disagreed. Harsh judgment. Historically, I've been a fan of Intuit. I think it's very well run, which is why I decided to do some homework, circle back. I got to figure out, like you often do, what the heck had gone wrong when it looked like everything was going right. The timing of this pullback was unlucky because after spending a year mostly trading sideways, the stock finally broke out to the upside this month and briefly blew past $700 for the first time in 3 years. Intuit initially joined in on the Trump rally, swept up in the general euphoria. But then last Tuesday, the Washington Post reported that Elon Musk and Vivek Ramaswamy, the 2 leaders of Trump's Department of Government Efficiency, of course, DOGE, want to make it easy for Americans to file their taxes via mobile app, which would be great for our country, but it would be terrible for TurboTax. So Intuit stock got slammed 2 days before the quarter. Doesn't matter that the Washington Post, which broke the story, admitted that all this is highly preliminary. Plus, we already have actually have a tool that lets you file your taxes online for free. It was part of Biden's Inflation Reduction Act, and this year they finally got a pilot program version, and it's up and running. So far, only a little more than 100,000 taxpayers are using it, which I find quite surprising. But maybe if it scales, it'll be a problem for TurboTax down the line. But given that this thing already exists, Intuit shouldn't be selling off on the news that Elon Musk wants to roll out another version of the same thing. Even though Intuit came down into the quarter, the company reported a strong set of numbers. This was a clean 14-cent beat, okay, off a $2.36 basis, higher than expected revenue of 10% year over year. They're also having a lot of success moving their customers from the old desktop version of QuickBooks to the subscription-based QuickBooks Online. What a fabulous recurring revenue there. At the same time, Intuit's Credit Karma business grew at an astounding 29% clip. That easily beat the estimates thanks to the strength in personal loans, auto insurance, and credit cards. Intuit's consumer group segment, meaning TurboTax, only really matters around tax filing season. But for what it was worth, that was also better than expected, too. In short, these numbers were pretty solid. Management seemed pleased with their performance. So then what was the problem? as is so often the case, the guidance. Even though Intuit just beat the numbers for the first quarter of their 2025 fiscal year, management decided not to raise their full-year forecast. A beat, no raise situation will almost always pressure a stock. On top of that, their guidance for the current quarter was meaningfully weaker than expected. They're talking 13 to 14% revenue growth. Wall Street was looking for 15%. They said they expect $2.55 to $2.61 in earnings per share, but the analysts wanted $3.25. The guidance is the guidance. Ouch. And that's why the stock sold off. That was big, though. It was big. And I don't blame anyone for wanting to get out of Doge or Dodge after a disappointing forecast for the current quarter. However, I'm not actually convinced there's anything wrong here. Believe it or not, I'm not. See, Intuit didn't raise their full-year forecast because that's irresponsible. This company has a weird fiscal calendar that's hostage to the peculiarities of tax filing deadlines. And the quarter they just reported isn't that consequential. It's like a retailer non-Christmas quarter, okay? Plus, with the new administration coming in, there could be a lot of changes that might impact the TurboTax business. As for the softer second quarter outlook, you need to check under the hood here because there are some quirks to this quarter. Intuit says it, quote, expects a single-digit decline in consumer group revenue due to some promotional changes in retail channels related to the desktop offering, end quote. But they also made it clear, I'm going to quote again, this only impacts revenue timing and does not impact overall unit or revenue expectations for fiscal year 2025, end quote. Basically, the consumer business is taking a temporary hit. No big deal. These guys have been money good. I trust them on this. What really matters for Intuit is not the current quarter. It's the one that's after. It's the tax season quarter. But if you're still worried about Intuit's guidance, keep in mind that we've seen this movie before. Do you know that 1 year ago, the company issued a really healthy beat, okay, but issued light guidance for the next quarter, the next 3 months ending in January. Do you know this is the exact same situation? And you know what happened? When Intuit reported again in February, they blew away the expectations. The company declined to raise its full-year forecast back then, too. But when the 2024 fiscal year came to an end, their numbers were comfortably above initial guidance. Long story short, Intuit's guidance tends to be on the conservative side because they're practitioners of UPOD. That's they underpromise and they overdeliver, which we love on Mad Money because a quarterly shortfall is a lot less likely. I'm clearly not alone in seeing this. Most of the analysts who cover the Intuit had positive reactions to this quarter, with many raising the price targets. That's a really good sign. I agree with these bullish responses to the quarter rather than the stock's negative reaction. The negative reaction, I'm calling it wrong. Yeah, we saw continued strength across the company's various businesses, with weakness only in areas that Intuit's intentionally moving away from, like the desktop version of QuickBooks and TurboTax products. Honestly, the biggest surprise of the quarter was the much better than expected performance from Credit Karma. If that can continue, it is great news for Intuit, which has been looking for growth drivers away from TurboTax and QuickBooks. They paid good money for both Credit Karma, the personalized financial management platform, and then this MailChimp, which is the marketing platform. Now, it hasn't been clear that either one of these deals were working out great. It's still fair to wonder about that $12 billion MailChimp deal. I mean, it really is. But now it sure looks like Credit Karma can be what Intuit was looking for when it shelled out $8.1 billion in cash to buy it. Yeah, it was cash in stock. I'm sorry. The darn thing, they did that 4 years ago. Now, I think that the 29% sales growth from Credit Karma is much more important than the conservative guidance for the current quarter. That's what you should be looking at. As for the longer-term threats to the business, the potential Doge disruption, I say let's cross that bridge when we come to it. Remember, this is a purely advisory bottom, like a government-funded think tank. They're throwing out a lot of ideas, but whether these ideas go anywhere is entirely another question. So here's the bottom line. I actually think that the stock going down was wrong. I think you're getting a nice buying opportunity in Intuit after the stock sold off in reaction to a good quarter with conservative guidance. Sure, there are some long-term risks like TurboTax, but the thing everybody's worried about, a government-funded alternative, it already exists, and the company's doing just fine. The franchise is strong. The stock can go back up, and the opportunity to step in and get some on the cheap is finally upon us. Bye. I say we go to Mark in New York. Mark.
Hey, Jim. Booyah.
Booyah,
Great
Mark.
getting through to you. I want to talk about a stock that I've been following for a while now. It's PayPal, and I wanted to know what your thoughts are because ever since Alex Chriss took over about a year ago, he said that he'd be innovating, he'd be making changes. He's focusing more on merchants now and data, so on and so forth, and it just reached its 52-week high. and I'm really excited. I want to know what you think about it.
Mark, you need to stay long PayPal. Ever since that interview that David Faber, my colleague, buddy, pal, friend from Squawk on the Street, did with Alex Chris, I said this culture has gone from loser to winner. Winner, winner, $88 dinner. That's where it's going. Right back, 42% gain. How fabulous. All right, listen to me. I think the fears about a government-funded alternative to Intuit's TurboTax are overblown, but because it's Musk, everybody believes, and that's why I think the sell-off looks like a fantastic opportunity for you. Much more Mad Money, including my post-earnings exclusive with HPA. Then after my series on the market's access, I'm addressing some people's crypto comments and setting the record straight on what I recommend. Don't worry, I'll be kind. It's Thanksgiving. And all your calls rapid fire in tonight's edition of the Lightning Round, so stay with Cramer. This morning, we got this curious referendum on the demand for AI PCs from Best Buy. Even though the numbers weren't all that great, AI PCs made up half of their total assortment. We're talking about a premium computers here that run on Windows. Now, after the close, we learned more when HP Inc. reported. The PC and printer maker delivered in-line earnings slightly better than expected sales. Their guidance was more cautious than I would have liked, both for the current quarter and for 2025 fiscal year. So let's get closer. First, not do the guidance. First, do the previous quarter, and then we'll deal with the guidance from Enrique Lores. He's the president and CEO of HP Inc. To learn more. Mr. Lores, welcome back to Mad Money.
Thank you, Jim. Great to be here.
Oh, great, Enrique. I'm glad you're here. I don't want to take my cue from the action because the action is often wrong. First, I want to hear from you about what you felt about the quarter. You clearly had better than expected revenues. You met the earnings, but there was some slight disappointment in the margins. Can you unpack this for me so I can understand what really happened?
Yeah, so I would say in Q4 we had solid performance, Jim. We grew, the company revenue grew 2%. And both businesses grew, both personal systems and print. We executed well, growing share in the key categories where we wanted to grow. We grew share overall in personal systems, especially in commercial. We grew share in print. We executed well our cost reduction plans. And this is why we delivered on our non-GAAP EPS goals and also on our free cash flow. So overall, that went well. From a margin perspective, what we saw in personal systems is pressure from a cost side. Component costs have increased, and we shared that in the previous quarter that we expected this to happen. And this is what had an impact on margin of PCs that we expect to happen to continue in the first half of 25, which is what is behind the guide that we provided today.
Okay, well, let's go over the printer side, because I've come to be suspect of printing, and yet you delivered a very fine number. Do you think that was one-off, or if that continued, I would think that your guidance was a little bit too cautious?
We think that, first of all, we are pleased with the performance this quarter. As I said before, we grew share in the hardware categories, right, and we delivered a strong result in supplies. When we look at fiscal year 25, in line with what most of the analysts are saying, we expect the market to slightly decrease. Okay. We will perform better than market. That's our goal. But we expect to continue to see pressure both in the consumer side, in the home side, and in the office side that will drive the overall market down.
All right, well, let's go over what your partner, Corey Barry, was saying at Best Buy today. She's basically saying that the best is yet to come for AI. Not yet, hasn't really happened. She's very excited about the future. How can she be excited from the future and you have let's say, a guidance that is a little more cautious than that would seem?
I think we have been very consistent in what we have been saying about AI PCs. We have been saying they would have a small impact in 24, more impact in 25, and more impact in 26. And I think this is very consistent also with Corey is saying. This quarter, we started to launch some of the next generation AI PCs, those that have really the powerful NPUs where you can run AI locally. And we have started to see what software vendors are able to do, the experiences that they are able to create. And we are very confident in the impact that this is going to have from a productivity perspective. We showed some of it when you were here, and we continue to be very confident in the impact and the value that this category is going to have for us in the future.
Let's drill down on the value. Mark Benioff, we know, who's wonderful gentleman, has a lot of different thoughts. He has been adamant that the Copilot does not have any value added. From your experience, have you had customers say that it was a disappointment, or have they almost the other way, almost universally say, you know what, I can't live without it?
I think when we have been demonstrated what AI PCs can do to our customers, they really see the value that they will have from a productivity perspective. And we have some large customers that have decided to adopt now AI PCs as the PC that they will be using for their full workforce. But we think this is going to take some time because they need to be qualified. Applications need to be developed to take advantage of the capabilities that this product have. And this is why the adoption is going to be gradual. We don't think that we are talking about cloud or AI PCs. Both things are going to coexist. There are activities that make sense to do at the edge and use AI PCs to do that. And this is what is behind the vision and the plan that we are building. But of course, for many other things, the cloud and the solutions that Mark is providing are going to continue to be extremely valuable to our customers.
Do you think it's too hard for an individual to know what to do? I had the great fortune of having your people walk me through the incredibly exciting things you have. I did feel that had I not been walked through, I wouldn't know how special they really are.
I think there is going to be an effort that we will have to do, that our partners will have to do, whether are software companies or resellers, to explain the value these products are going to have. What is special about AI PCs is that the penetration is going to start from the commercial side. And if you think about how innovation has come to market in the last years, has been more from the consumer into the commercial, this is reverse, which means more explanation is going to be necessary. But again, when we demonstrate what customers will be able to do, they really see the value and they realize that this is the type of product that they want to have for their teams.
All right, well, let's think big here for a second. You know, we've got Jensen Huang, we've got NVIDIA here. We see all the excitement. There's just lots of big think, a lot of moonshots. And then you get your Hewlett-Packard PC, which you know I have, and I do love, and I just think it's sensational. But I don't see those particular qualities. I just see a super fast, good machine. Is a super fast, good machine enough right now to make it so that perhaps you could exceed your guidance next quarter?
I think superpower, as you are saying, and super powerful is going to help. Our goal next year is to grow more in the commercial side. This is where we see the strongest opportunity. And it is not only going to be only about the performance of the PCs, it's going to be about the capabilities and the new applications that customers are going to be able to do. So the more applications that will be available, the bigger the impact that the AI PCs are going to have.
Excellent. Now, I'm looking at your product development and manufacturing page and your table of contents. I see lots of countries. I only see one entry of China. Is it fair to say that those are equally distributed, or is the China Shanghai property the lion's share of your manufacturing?
China continues to be a big part of our manufacturing footprint, but we have been diversifying fairly aggressively during the last 3 years because we realized that we needed to build a more resilient supply chain. We have been driving a lot of change, and now we're in a much stronger position than we were 3 years ago when we started this process.
Okay, so what headwind would you ascribe a 10% tariff in China to your numbers?
Well, first of all, we need to wait to see what the final tariffs are going to be because numbers have been changing during the last weeks. What I can say is, first of all, the work that we have done in the last years is going to significantly help because we have moved a very relevant portion of the products that will come to the U.S. outside China. And we have a very competent team that has proven that they know how to manage these situations, and that I know, as we will know what the new tariffs will be, we'll design the right supply chain footprint for the company.
Excellent. Okay, so we'll stay in touch. We'll keep following the AI PC. I understand it's not necessarily a slower ramp. It's a longer ramp, not unlike what we're seeing with Apple, with its new phone and Apple Intelligence. It just takes a little longer than some of us would like because we think it's so exciting. I want to thank Enrique Lores, the president and CEO of HP Inc. It is a joy to have you on the show, sir.
Thank you, Jim, and happy Thanksgiving to you and your family.
Same to you. Exactly. Mad Money's back after the break. It's time. It's time for the lightning round. Of course, the same in the stock. I tell you about buy some, but just because the core stocks at that way might say for the grab so plan this out. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Crazy. Might start with Srinivas in Ohio. Srinivas.
Yeah, Jim. Booyah.
Booyah.
The stock I'm looking for is Aptiv, APTV.
Yeah, auto parts. I am concerned that many auto parts may be made in China. We don't know. AutoZone had a very good quarter. I would go with AutoZone. Let's go to Stacy in Georgia. Stacy.
Dr. Cramer, Stacy from Atlanta here. Thank you for taking my call.
My pleasure.
I'm curious, with the upcoming Trump administration and the AI frenzy, I want to get your thoughts on this stock. Is it a turkey or is it a buy? Recursion Pharmaceuticals.
I like the story at 10, and I have to tell you, you know what that makes me? That makes me wrong. I knew that NVIDIA had a stake in it. They still do it and made me get excited about it. I think that at this point, then they did a secondary offering and it didn't hold. Now I think at 5, it is worthwhile speculation. Let's go to Mike in Massachusetts. Mike.
Booyah, Jim Cramer, and happy Thanksgiving from Boston.
Oh, same to you. How can I help?
I'm looking at Zoom Info Technologies, ZI.
Marketing company. Not enough specialty. Not enough mode. Let's pass on that. Now we go to Andy in California. Andy.
Good morning, afternoon, Mr. Cramer. How are you today?
I am doing well.
Excellent. I noticed Supermicro had a little bit of a run the last couple of days. Is it safe to get back in?
No, my view is accounting irregularities equals sell, and I never go back. I will be happily willing to miss another 20 points. It doesn't matter. Accounting irregularities equals sell has saved me millions of dollars. Let's go to Daniel in Florida. Daniel, my brother.
Hey, Jim. This is Daniel from Miami, Florida. Happy Thanksgiving to you and your family.
Same. Right back at you.
Thank you so much, Jim. I'm calling on a company called Red Cat Holdings, ticker symbol RCAT.
Yeah, they do flight recorder. I mean, look, they have a business. Red Cat has a business. However, the stock just went up 850%. I am willing to pass on an 850%er. I don't want to bet that it's going to go up 1,000%. It's just not my style. I need to go to Tommy in Michigan. Tommy.
Hi, Jim. I'm calling from Saginaw, Michigan.
Excellent.
First-time caller, long-time fan of the show, and investing club member.
Oh, thank you.
I'm mostly retired because of you, so thank you for everything.
Oh, fantastic.
I wanted to hear your thoughts on a local company, Dow Chemical, their earnings call, and since they got dropped from the Dow Jones.
This is a tough one. I think that Jim Fitterling does a great job, but it needed China. It needs prices can go up. It needs a much stronger economy. It yields 6.29. A lot of people bought it in the 50s thinking that it wouldn't break down through the 5% level. If you don't have growth and you sell it 21 times earnings, you're not going to be able to do anything. At these prices, I'm willing to put a position on, but understand that the dividend turned out to be, the yield turned out to be not the kind of protection that we thought. Bill in Massachusetts. Bill.
Hi, Jim. I just wanted to wish you, your staff, and your families happy holidays.
Oh, thank you, Bill. Thank you. Right back at your family, too. How can I help?
Thank you so much for everything you guys do for us. I'm a club member.
Oh, fantastic.
I trimmed up three club stocks today just because I didn't want to be a pig like you teach us. So, I'm trying to do the right thing. Yeah,
well, as long as we're trying to make money together and we're teaching. I'm teaching. I'm learning from you. It's a teaching product. There's never been one like this. I'm very proud of it.
You have to take your profit. That's the discipline that you taught me, Jim. I love it. Jim, we talked about 4 months ago about this equity, and it was about $46 a share. I picked up 10 shares. You told me it was a doubler. I loved it. I called you back. It was $73 a share, and I got 10 more shares. Now it's to the roof. It's Reddit, my.
I think Reddit's fabulous. What can I say? I know it's up a great deal, but I think Steve Huffman's doing a fabulous job. I'm not a seller. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Lightning Round is sponsored by Charles Schwab.
Good feedback on our three-part series on froth and excess yesterday. You know what? I actually expected severe blowback because I'm basically saying you need to sell something, anything, just to lock in some gains. As I see it, the biggest sin in investing is turning a gain into a loss. And having committed that sin many times, I always have to check to make sure that I'm not being too greedy. I thought others would say, how can you ever really sell a winner? Well, the answer is sell some, take your cost basis out, and then you can let her ride. However, there was one place where I was criticized. I got a bunch of yahoos saying I called the top in crypto by recommending it. First, I need to say that I typically do not read the comments on Twitter or X, whatever it is. I have pretty thick skin, and even if I can only take so much abuse, I can't. There are just too many people who want to rake me over the coals for something I did wrong 10, 15, 20 years ago, or who think it's funny to spoof me like this crypto comment. Ha, ha, ha. To me, this is internet idiocy at its best. I've liked crypto for a very long time, mostly because I know there's a huge constituency of investors who want to buy something that can protect them from our government's busted budget. While there's no proof crypto can protect you from anything, at least not yet, it's a plausible story, and it's something that, well, let's just say sometimes that's all you need in this business. I hope the American economy can grow its way out of that huge deficit via higher tax receipts, but I fear that someday we're going to get in one of these partisan debt ceiling fights, and some White House official will start talking about a cram down or a buyback of Treasury bonds at a discount. I am disappointed that both the Obama and Trump administrations refused to issue longer-term 50-year paper, take advantage of those ultra-low interest rates that aren't there anymore. Would have been a huge money saver. Instead, we have all this short-term paper that's now being issued at higher rates. What a mistake! So I own some crypto, and I owned it for ages as a hedge to the idea that someone in the Treasury Department truly decides to do something crazy, call our bonds, say, north of par. Don't laugh. Consider Executive Order 6102. Don't know it? In 1933, FDR, revered president, issued that order, confiscating gold from the people of the United States, of you and me, in order to stabilize the banking system. Remember, back then we were still the gold standard. The penalty for not turning it over to the government was a fine of up to $10,000. And that's when $10,000 was a lot of money. Worse, you go to prison for 10 years. Some jewelry, $100 in gold coins, and artists and dentists were excluded. But from a modern perspective, this was an absolutely insane move, downright un-American. In the context of the Great Depression, the banking regulations of the time, where the Fed wasn't allowed to lend more money unless it had more bullion, you can see why FDR did it. But the whole situation was absurd. Now, these days, I still have some gold as a hedge, but because it can be easily confiscated, done once can be done again, I think Bitcoin, Ethereum, maybe even some other cryptocurrencies deserve a spot in your portfolio, too. Maybe one day if the deficit gets under control, I'll change my tune. But anyone who's followed me for more than 10 minutes knows that I'm a huge skeptic about our government's ability to balance the budget. It's not that we don't know how to solve the problem. It's that legislators lack the political will to do things that are unpopular. Balancing the budget means making painful decisions to raise taxes or cut spending. Most politicians would rather just kick the can down the road and make somebody else deal with it, ideally the opposition. So I own crypto because those national debt worries are never going to go away. Maybe not in my lifetime, but I'll go ahead. I'm going to call the top by recommending it yet again. Weird how I've been recommending gold and crypto for so many years, and yet they're both near all-time highs, and I take heat anyway? Gotta go back to not reading the comments. Just ain't worth the aggravation. I'd like to say, as always, bull market summer, and I promise I'll find just for you right here on Mad Money. I'm Jim Cramer. See you next time.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.